makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London with the conversations that matter. And here's what's coming up on today's programme. Israel says it will launch a ground offensive on the city of Rafa unless Hamas releases hostages by the start of Ramadan next month. Apple is set to face a near €500 million fine from the EU over allegations it silenced music streaming rivals on its platforms, including Spotify. Plus, UK lenders in focus this week with some of the largest banks set to report. We will preview earnings from Barclays, Lloyds, Standard Chartered and HSBC. Let's check in on these markets then. On the banking front, interesting to get a line through from Santander on the buyback plans coming through for that Spanish lender. Currently across the European markets, it's a little bit muted after you saw the gains on Friday, getting close to the highest levels that we've seen since early of 2022 by the close on Friday. A bit of a breather so far across the European session here in Europe. Weighing up, of course, the inflation data out of the US, the stickiness that came through last week with CPI and PPI. Here in the UK, the FTSE 100 currently trading at 7,707, just down a few basis points, 4 basis points so far on the FTSE 100. We keep an eye on basic resources and the miners on the softness that's come through from iron ore, for example. That ties to the China story that we'll unpack through this hour. The CAC current over in France currently down 0.4%, and over in Germany, the DAX off by 0.3 or 52 points. China has been the story of the moment, coming back from the Lunar New Year holidays. We've seen gains on mainland indexes, but arguably not the kind of strength that some would have expected, given that high-frequency data in terms of trips to Macau, in terms of cinema visits, in terms of what we saw on hotel bookings and the sheer number of travellers. Arguably, the stock response hasn't been as robust as many would have hoped. We get the loan prime rate decision coming through tomorrow, so we watch for that as well. All of this, of course, on a week where we get inflation data out of the Eurozone and more insight into the Fed's thinking with the Fed minutes later this week. As the market's increasingly in line with the dot plots, now expecting 90 basis points of cuts this year versus 75 for those dot plots. But that's a change from 150 basis points flagged at the early part of this year, back down to 90 now for those markets. Let's get more then on all of this and bring in Justina Lee, China markets reporter here at Bloomberg, and very pleased to say Ursula Marchioni, BlackRock's head of markets and portfolio solutions in the EMEA region. Ursula, let's start with you. Good morning. Thanks for joining us in the studio. What do you make of the stock reaction from Europe so far? We look at the gains that have come through year to date. We look at the relative optimism, despite the concerns about, for example, the German economy, and yet we're pushing close to record highs. Bit of a breather today, but does the momentum for European stocks, does that maintain itself? Is there further upside for European stocks through this year?
Yeah, very good question. Good morning, by the way. So I think taking a step back, we are going to a new phase of the cash redeployment that investors are looking at in Europe specifically. And so if you take a look at 2023, very high cash balances, $8 trillion in money market funds at peak towards the end of Q3, now starting to be redeployed. European equities is not an area where I see European investors actually pouring in. So last quarter, 2023, was very much around investment grade, high yield, so the higher risk part of the fixed income spectrum. A lot of that is carrying on. So if I look at exchange traded products as a barometer of investor sentiment this year, it's been about investment grade. We've seen 14.5 billion pouring in into January alone, second month on record. Second component is tech, which continues to be in favour, over 12 billion year to date. Think about the second largest sectors being healthcare at 1.5 billion. So you see the difference there. And then number 3 will be emerging market equities. So I think Europe is an area where obviously our clients are overweight. It's home buyers without a doubt, but it's not an area where I see more interest at present in terms of strategic establishment.
Okay, well, there's a lot to unpack there. So we'll get your views on some of that through this segment. But just on that deployment through Europe, you think most of the money is going elsewhere. We're seeing money returned to shareholders, though, in Europe, whether that's increased dividends or buybacks. Is that a potential catalyst for the European stock story?
Yeah, that is a very good question. I think it can be. Nevertheless, if I think about the behavioural drivers, it's really related to the starting position of your portfolio. And so, again, if the starting position is already well exposed to those markets and components. Actually, it's a very pertinent question. This week we publish our strategic investment views at BlackRock. From those we derive asset allocations, and we compare those positions, our view of the world, towards where investors are. We looked at over 500 billion of European assets held in multi-asset, flexible and balanced funds. Again, Europe is overweight, and so if you were to ask me, I would see a potential for resizing of a US equity exposure, a Japanese equity exposure. In Europe, rates are an area where we see an under-ownership. So yes, I think, returning value to shareholders can be a catalyst, and yet in terms of large money in motion, it will also be very much rooted in where investors are today and where are the deltas.
OK, it's interesting you bring up Japan, given that your colleagues have come out with a note as well, seeing further upside for Japanese stocks, to your point. So staying in that region, staying in Asia, but drawing on the expertise now, Justina, around China. And of course, we have seen China come back from the Lunar New Year holiday, at least the mainland. Hong Kong reopened on Wednesday. What do you make of the market reaction? A little bit more muted. We did see the gains come through for the CSI 300, the benchmark over the mainland, but arguably not the kind of gangbusters start post-holiday that maybe some had expected. What is your take in terms of what we've seen from Chinese markets?
Yeah, that's exactly right, especially coming from tourism and tourist spending data. That was actually a bit better than expected and showed some pickup from before the pre-COVID period. And I think one thing that's kind of telling today is that we did see the CSI 300 close up, but we did see a lot of ETFs buying. So there's kind of some chatter that maybe this was kind of government support. And also we still saw, foreign investors selling onshore stocks. And I think what this really tells you is sentiment at this point is so weak, and the concern is so much on the structural issues rather than any kind of short-term boost that you're really kind of waiting for the government to do something a lot more decisive.
And there seems to be almost consensus. The guests that we speak to say we still need more from this government. The government could argue that they pushed through a number of measures over the last 12 months, that maybe if you put it all together, it's quite a significant package of support measures. But we look ahead. The here and now, the focus is on the loan prime rate tomorrow. Do we expect a move there? Does increased liquidity into the financial system of China, does that really matter when sentiment is so weak and has been so battered?
And yeah, I think the investors will be disappointed if we don't see a movement to the loan prime rate tomorrow, which is what a lot of economists are expecting, especially after yesterday. The Chinese premier kind of said that, we need something pragmatic and forceful. Those were his words translated. But it was also kind of telling that yesterday we didn't get a cut in this medium-term lending facility. And so it might actually reflect some concern possibly about the Chinese yuan, especially given kind of the latest bout of dollar strength we've seen lately. OK, so you're giving us a nod to the Federal Reserve there, aren't you, in terms of the concerns potentially about the weakness of the yuan in an environment where maybe the Fed holds for longer. Ursula, on China, are you seeing any appetite from your investors, from your clients, in terms of the flows that you're seeing to get exposure now, given the valuation that, for some at least, looks appealing?
I hear you. It is under-owned, without a doubt. So, again, in this last round of scouting the market to see where the average allocation is, we see China being below benchmark. Yet, I agree, there's some interesting movements in that part of the world. So, of the 160 billion inflows into the global ETP markets this year, 42% came from APAC investors. And that is very different when you compare momentum flows vis-à-vis ownership. Only 11% of the global assets under management actually are held in that part of the world. And so I think there's clearly something happening. In Japan, we've seen a return of end investors into the equity market. I think that's part of that. So it's a fascinating moment. The under-ownership, I think, is a signal that something could be done. And yet, I would agree with Justina, it's around, the broader stimulus package. Valuations have come down, so that could be a positive. But again, geopolitical risks remain high. From a structural perspective, the demographic challenges are there.
You're not convinced yet. You wouldn't be making the call. You want to be loading up on Chinese assets at this point.
Yeah, from a strategic asset allocation, I think, again, in relative terms, I'm seeing larger underweights that are more costly for investors at present than that specific one, although it should be,
So I get the sense you really want to talk about Japan, and we touched on this, because what stood out to me from the analysis coming through from your team on the call around Japanese equities was, one, that Japanese equities is still under-owned, and you've just reiterated that point, and number two, that even if we do get an end to ultra-loose monetary policy, which many expect could happen March, April from the BOJ, even if that happens, Japanese stocks are still appealing.
They are. I think there's a lot of positive momentum coming through the corporate reform that we saw last year. Again, high number of earnings upgrades, which I think needs to be taken into account. And again, this march out of cash that the Japanese investor population is onto, with the numbers that I mentioned earlier, it's something that we haven't seen in a while, Tom. So, yes, I think the three combined pose a very interesting backdrop that investors should be considering.
OK, Ursula, thank you very much indeed. Very pleased to say Ursula and Justina Lee will be staying with us for the next block. Ursula Marchioni, who, of course, is going to give us more market analysis. We'll talk about fixed income. We'll also do a bit more deep dive in terms of these central banks and the view around the Federal Reserve as well. Coming up, though, facing the music, Apple set to receive its first ever fine from the European Union after a long-running dispute with Spotify. We have the details on that story. Stay with us. This is Bloomberg. Welcome back. Happy Monday. Now, Apple is said to be facing an EU fine of nearly €500 million over allegations it silenced music streaming rivals like Spotify on its platforms. Bloomberg's Alex Webb joins us now with the details. Alex, what is behind this case? How substantial is it for Apple? How significant, indeed, is it for Spotify?
So it's all grounded in what were known as Apple's anti-steering wheel rules. That, like, if you have a product or service that you sell through the App Store or through iOS, if there's a subscription fee, Apple might take 30% in the first year, 15% in the second. That means that if you're Spotify, if you're charging $10, then of course $3 of that are going to Apple. So what Apple had a rule in place that was like, you cannot through your app say, it will cost you this much if you subscribe through the app, but if you go to our website, thereby evading Apple, and subscribe with us directly, we'll actually charge you a bit less. It had a rule against that. That is what is now being targeted by this European Union fine. There have been some changes to that approach in the meantime, but this is obviously a fine for things that have happened historically. What does it mean for Apple? Well, the financial implication, it's not the money that they would like to pay. It is money that Apple can afford to pay. Of course, they're sitting on, $100 billion of cash, not on a net basis, but a lot of cash. It clearly will help Spotify a little bit from a margin perspective. More significantly, though, is what the implications are then for other services that Apple tries to charge what some people call the Apple tax on, that commission they charge. We're looking at a world where the App Store is already being massively opened up to other competitors, and Apple won't be able to take as big a cut.
OK, so it's not just implications for one product or one service. It's broader than that. Is this, though, part of a wider crackdown by the EU, or is this firmly focused on Apple and those particular services at this point?
Well, obviously, this ruling, if it comes through, of course, it's being reported from sources at this stage, very much about this thing. We are already seeing rules there where Apple is going to be forced in the European Union to allow third-party app stores to operate on its platforms. It won't, therefore, in those cases, be able to take, anything like the cut that it's been able to take previously. There is a broader push within Europe to focus on what are known as gatekeeper companies who, own the gates to big consumer platforms. Think about things like Google Search, about Meta, which owns Facebook and Instagram, and increasingly, of course, of Apple. So it is part of a broader trend. This ruling, of course, pertains to just the one service.
OK, Bloomberg's Alex Webb on the implications of that almost €500 million fine levelled against Apple from the EU. Alex, thank you very much indeed. We'll stay on the tech story. We'll broaden it out. Justina Lee will bring back in alongside Ursula Marchioni from BlackRock. Justina, let's start with you on the question of tech this week with the focus on earnings. Nvidia's coming through on Wednesday, but more broadly, where is your lens when it comes to the earnings story this week?
Yeah, it's actually been kind of a pretty positive earnings season so far in both Europe and the U.S. We've seen kind of EPS growth kind of trend up a little bit. And especially in the U.S., we're still seeing kind of pretty solid, EPS and sales beats. And I think one interesting thing is obviously this year has all about the concentration of gains in the tech mega caps. And that's why kind of Nvidia will be really important here for kind of where the index goes next. I was really shocked to see that it's actually already up like 47% this year so far. So, I mean, looking at Bloomberg Intelligence, they're expecting another solid fourth quarter, positive outlook for 2025. People still have demand for Gen AI. They kind of still have demand for GPUs. But can Nvidia live up to those expectations? I think that is sort of the question here.
Yeah, as you say, 50% year to date, 250% over the last 12 months. Ursula, we'll bring you in at this point. Do you see that enthusiasm? Do you see the rally that we've seen in the US? Further gains, of course, year to date of around 5% for the S&P. Goldman Sachs raising their forecast to 5,200. A lot of that is on the earnings story, on the profit story. A lot of that focus, or a lot of that call coming through from Goldman Sachs is on the role that technology plays. Do you see the upside broadening beyond those big tech mega caps?
Yeah, that is a key question. So I think that from a benchmark perspective, we're neutral on the US because, again, all the reasons that you mentioned. Yet the AI mega force is so US-centric. And so when you take that into account, I think overall for the US market, for us, it is an overweight. And so the connection, though, with the very, very low dispersion, super high concentration of the momentum in the sector is something to be aware of. It doesn't seem to matter to investors that much in terms of exchange-traded product flows, 12 billion going into tech. We see the momentum continuing. It started at the end of last year, carrying through. It has room to grow. And I think that mega force component will give room for the trade to play out. But I agree with you. The concentration continues to compound and grow, and that is something to watch. OK, and all of the upside that we've seen coming through from technology, despite the fact that interest rates are at 5.25%, or between 5.25 and 5.5 in the US, and we still don't have clarity as to when exactly that will change. Talking of the Fed and talking of central banks, we heard from Larry Summers, of course, former Treasury Secretary, talking about the risks maybe of even an increase in interest rates from the Fed. Take a listen.
I think that May is odds off at this point and probably should be odds off. And gosh, I think we've got to recognize what no one's talking about. There's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards in rates.
OK, a 15% chance that the next move from the Fed could be a move higher, not lower. Ursula, what do you make of the inflation risks and the risk that maybe the markets are underestimating the stickiness of inflation and what that could mean for Fed policy decision-making? Do we need to even start considering, even start factoring in the possibility, if not now, if not this year, then at some point in the cycle of a hike coming through from this Fed?
Yeah, so I think, Tom, like our central scenario is still around, 2024 path being quite clear in terms of cuts. And so acknowledge the 15% chance. That is not the central scenario that we have. But certainly we do have a steepening view on the US curve in terms of these long-term structural and inflationary pressures. And so in terms of, again, going back to European investors, opportunities to resize the fixed income sleeve specifically, under ownership at present vis-à-vis our strategic views is more around European rates, where, again, from our perspective, that concern around the long-term structural inflationary pressure is less severe, and therefore we're more comfortable in onboarding potentially in duration now. OK, Ursula, thank you very much indeed. Ursula Marchioni, Head of Markets and Portfolio Solutions, EMEA at BlackRock, and of course Bloomberg's Justina Lee, our China markets reporter based here in London. Thank you both very much. There's plenty more coming up on Bloomberg. Stay with us. This is Bloomberg. Welcome back now. Shares and curries are rocketing this morning, up almost 34%, around 34%. That's after the Chinese e-commerce operator
JD.com said it was considering buying the UK electronics retailer. JD has until March the 18th to decide whether to make an offer. It comes at a time that the Beijing-based retailer is seeking new avenues for growth in the face of rising competition at home. Currys has rejected a preliminary offer of 62 pence a share from Elliott Advisors, saying it, quote, significantly undervalued the London-based company. Zooming out from the stories of Currys to the broader story around US equities. Of course, the US markets closed for President's Day today, but Goldman Sachs revising their forecast for the S&P higher. 5,200 is now where they see the S&P ending 2024, upgrading from a December forecast of 5,100. They say profits are looking healthy for US corporates. They see a soft landing. It's all about the earnings momentum with a particular focus on technology. So just bear that in mind as we look to that reopen of the US markets on Tuesday. Now, coming up, Western leaders express outrage at the death of Putin critic Navalny. We take a look at the details and the implications. This is Bloomberg. Welcome back. Now, Israel says it will launch a ground offensive on the city of Rafa unless Hamas releases hostages by the start of Ramadan next month. Apple is set to face a near €500 million fine from the EU over allegations it silenced music streaming rivals on its platforms, including Spotify. Plus, UK lenders in focus this week with some of the largest banks set to report. We will preview earnings from Barclays, Lloyds, Standard Chartered and HSBC. Good morning and welcome to The Pulse. I'm Tom Mackenzie in London. Let's focus in on geopolitics now. And Israel says it will launch a ground offensive on the Gaza city of Rafa unless hostages still held by Hamas are released by the start of Ramadan next month. More than 1 million Palestinians fled to Rafah in the southern part of the Gaza Strip during the start of the Israel-Hamas war. Israeli War Cabinet member Benny Gantz has promised to facilitate the evacuation of civilians in coordination with the US and Egypt in order to minimise casualties. Let's bring in Bloomberg's news director for the EMEA region, Rosalind Mattison. Ros, what has the reaction been then to this deadline, this apparent deadline being set by Israeli leaders?
Well, obviously, at least it gives everyone a bit of a time frame to work with, because Israel's been saying for weeks that they do intend to go into Rafah at some point. As you say, that's that right near the Egyptian border. You've got at least 1 million Palestinians bunched up in that area, and Israel says they need to go in because Hamas is operating in that area, but obviously high concern about what happens to all the civilians who are there at the same time. And so now we know at least that Israel's saying that, you know, if the hostages aren't released by the start of Ramadan, which is around the 10th of March, likely that they will intend to go in. And so that gives several more weeks, obviously, to try and get some kind of ceasefire agreement to get those hostages released, probably in exchange for prisoners who are currently being held in Israel. But the question is, if there is an offensive during Ramadan, what does that look like? Obviously, that's a very important time. That's a holy period for the Islamic world. What does it mean if Israel chooses that moment to go into Rafah? Yeah, as if tensions in the Middle East were not high enough without that added element to tie into it. What does it mean potentially, this deadline that Israel seems to be setting? What does it mean for negotiations? What does it mean for the conversations about the release of those hostages that continue to be held by Hamas, at least parties and groups linked to Hamas? Well, the challenge is, as we know, is that the Israeli Prime Minister Benjamin Netanyahu said he was not going to participate, or Israel was not going to take part in those further talks that are being, facilitated by Egypt, by Qatar, involving the US, obviously through intermediaries with Hamas, because Hamas is not acting in good faith. And fundamentally, there are big differences about what a ceasefire would look like to facilitate the hostages being released. And is that a short-term ceasefire with an agreement that needs to be a permanent ceasefire tacked onto that? What happens to Israeli troops during such a ceasefire? And so you can't even get those points addressed for a hostage release. So we are really running the clock on this, because it does seem, regardless of what happens, that Israel is determined to press ahead with this offensive inside Rafah. That's despite the criticism and concern being expressed by the US, by the UK, by key allies, but also by major nations in what we call the Global South, so countries like South Africa and Brazil.
Yeah, indeed. OK, so we switch our focus from one geopolitical hotspot to another, and this, of course, Russia and its continued fight and war in Ukraine, making some advances over the last few days, at a time, of course, when Western leaders were gathering at the Munich Security Conference. Talk to us about what was said at that event, what the urgency is, and the implications of those gains for Russia.
Well, it's interesting that contrast, as you say, because as we had the Munich Security Conference going on, we had leaders, senior officials gathered there expressing a high level of concern about what's happening inside Ukraine. Ukraine is clearly running out of ammunition and other key weaponry that it's been asking the US and others for. That's being held up in the US Congress. And, tangibly, that's showing up on the ground. We had, the loss of this city. Ukrainian forces have pulled back out. That's a symbolic gain, obviously, for Russia on the ground, but they've been occupying quite a bit of territory in the south and the east of Ukraine for many, many months now. So the question is, as time goes on, does Ukraine really lose the advantage on the ground without that weaponry? And a lot of talk about that in Munich, but still no great promises about how to address it.
OK, Ross Madsen, thank you very much indeed with the latest when it comes to what we heard from the Munich Security Conference and, of course, those gains, if largely symbolic for Russia, and, of course, the latest when it comes to Israel's apparent deadline for Hamas. Thank you. Now, more than 300 people have reportedly been detained in Russia after the death of prominent opposition leader Alexei Navalny. Hundreds of people in dozens of Russian cities gathered in ad hoc memorials with flowers and candles, joining tributes around the world. Here's the reaction of the US and French presidents.
Putin is responsible for Navalny's death. Putin is responsible. We're looking at a whole number of options. That's all I'll say right now.
Russia has ultimately lost strategically because it puts its free spirits in the gulag. It condemns them to death, like Mr. Navalny, whose memory and engagement I salute. And tonight, I'm thinking about his wife and family.
OK, hearing there from the presidents of France and the US, of course. Let's bring in now geopolitical strategist Tina Fordham, the founder of Fordham Global Foresight. Tina, thank you for joining us in the studio to talk through this subject and the potential implications for Russia and the West and, of course, the domestic opposition, to what extent that still remains in Russia. What is the potential meaningful repercussion that could come through from the US and the US allies to the passing of Navalny? Is the toolbox empty for the West, or is there meaningful punishment that can be laid at Russia's door?
Well, this is what President Biden had said in the past, that if Navalny were to die in custody, which is what has clearly happened, that there would be a price to pay. And we also heard the very emotional speech from Navalny's widow at the Munich Security Conference talking about justice. I think the unfortunate reality is that there are unlikely to be very many policy triggers that can be pulled to punish Russia further. But that does not mean that Navalny's death is without significance. It's not a market-moving event, but it is a major signpost in Russia's political trajectory and in the way that it will be engaging with the West.
Does it embolden Putin? Is this a Vladimir Putin who is more emboldened because of the relative successes that have come through in the last few months on the ground for Russian forces? Or is there a risk, longer term, if not now, that Navalny becomes a martyr to which opposition gravitates?
Well, Navalny already is a political martyr, right? I mean, he wasn't a saint, but he is now a political martyr. But he's one in a very long line, unfortunately, of opposition politicians who've been murdered, going back to Anna Politkovskaya, who was assassinated on Putin's birthday, to Alexei Litvinenko, who, of course, was poisoned here in the UK. This is just the most recent one. And the regime in Russia kills with impunity and also with cruelty. We're seeing that his body apparently is missing in this remote Arctic prison. It's at the morgue. It's not at the morgue. The cruelty is part of it. Putin is playing us in the West, and I think it's important to understand that. It was only a few days ago that U.S. journalist Tucker Carlson was there, famously talking about the supposedly glorious state of Russian supermarkets and the indeed very majestic Moscow metro. I lived in Moscow for years. All of that is true. But we have elections coming up in Russia in March. What are the repercussions for Putin of this? They are probably minimal, but in concrete terms, the existing measures under discussion, like redeploying Russian assets and transferring them to Ukraine, will gain more momentum. It's hard to see how much more can really be done on sanctions. But just as the war in Ukraine brought more members into NATO, I think we will see much more defense spending as well.
OK, you touch on the US and the narrative amongst some sections of the Republican Party, some sections of the right, around their views on Putin and Putin's Russia. Is this likely to change that narrative even at the margins? Is it likely to do anything to change the debate around the spending package that remains held up in Washington?
Well, these are two different things, right? So those who lionize Putin and who, sort of glorify the supposed strength of autocrats are not likely to be put off by the death in custody of an opposition figure, right? I mean, even Tucker himself said at the World Government Summit that leaders have to kill people, which is quite a remarkable thing for an American journalist to say. The question about whether U.S. military aid to Ukraine will pass in the House is a different one, right? So if we look at U.S. public opinion, data from the Pew Foundation shows us that 74% of Americans believe that it's important and in U.S. national interest to support Ukraine. We also know that a straight up and down vote in the House of Representatives would pass, but the Speaker won't allow that to happen. So the question should be, why not? And the only explanation that I can come up with is that the political repercussions are actually coming from President Trump, who's almost seems to be a president in waiting at the moment in terms of his influence on the policy agenda in the House of Representatives.
So wielding power already, even if he is, if he's
certainly
not,
wielding
not in
influence.
Wielding influence,
yeah, over what can happen.
Right,
and the longer the conflict takes, the more it plays into Putin's hands, the more the European security risk premium goes up as a result.
So what ultimately brings Putin to the negotiating table then?
Well, I mean, we know from the history of conflicts that they end when one side gets tired, whether that's having, sacrificed too much in blood or treasure. We're really not at that point. For Ukraine, it's an existential crisis. Public opinion in Ukraine does not support territorial concessions. And, of course, there's no evidence that Ukraine giving up territory would end this conflict anyway. Putin wanted to take the entire country, not to keep Crimea. He already had that in effect. So there's no incentive, as I see it, for Putin to go to the negotiating table until there's an outcome in U.S. elections in November. Former President Trump has already indicated his allegiance or support for the Russian regime. And this is true of not only the conflict in Ukraine, but elsewhere. There'll be a lot of world leaders or non-state actors who are going to wait and see what happens in the White House on the possibility that conditions for negotiation will be more advantageous. That's a rational strategy.
OK, Tina Fordham, thank you very much indeed. Always bringing the smart analysis on this topic for us. The founder of Fordham Global Foresight and all the events that unfolded over the last few days in Russia, Ukraine, and, of course, the implications of Navalny's death more broadly and longer term. Thank you. Coming up, rising tensions, meanwhile, between Somalia and Ethiopia are in the spotlight again. We'll discuss the feud between the neighbours reaching boiling point during the African Union summit over the weekend. Stay with us. Welcome back. Let's check in on the oil markets right now. 9:44 here in the city of London. Brent trading at $82.82, currently down 0.8%. on the session, coming off a 3-week high that was notched at the end of last week. NYMEX WTI, NYMEX crude, currently trailing just below $79 a barrel, down 0.3%. It seems like the demand concerns are offsetting the geopolitics, at least for now, when it comes to oil. When you're thinking about demand, of course, slow down broadly in this global economy, but also, of course, China coming back from the Lunar New Year holiday. So the demand question appearing to offset the geopolitics, at least for now. Brent down 0.8%, WTI back below $80 a barrel. Let's stay on the subject of oil and bring in, from our interview with the CFO of one of the world's biggest oil companies, Vonnie Quinn, who's been talking to the president, the vice president of Aramco in Riyadh, Aramco's executive vice president and CFO. Vonnie, thanks for joining us. What were the key takeaways?
Yeah, absolutely, Tom. I mean, you mentioned the fact that supply and demand imbalances are perhaps moving this market a little bit. We know that oil has been trading in a range, so I asked Ziad Al-Murshid, what are they planning for? Citi has a $60 a barrel outlook for oil. We know that Bloomberg Intelligence tells us the Saudis need $108 a barrel in order to balance the budget. Well, Mr. Al-Murshid said, you know, obviously we're prepared for anything, and we know that. We know that Aramco has the best margins in the business. They can literally produce a barrel of oil cheaper than anybody else, any of the big oil companies, right? They said they're ready for anything, but also that supply is adequate for demand, and I think that says a lot. So while he was positive about demand returning post-pandemic to practically pre-pandemic levels, very positive about that, at the same time the fact that they think supply is adequate tells us a lot. What also tells us a lot, and in the same vein, is that the Saudis and Aramco specifically didn't increase the MSC, the maximum sustainable capacity, to 13 million barrels a day from 12 million barrels a day. That was an anticipated move, and then it got cancelled or at least postponed. I think that says a lot about what the Saudis and Aramco think about how well supplied this market is, right? It's well enough supplied, and that seemed to be the message from Mr. Al-Murshid today. The other message that he left us with was quite a strange one, actually. He said that spare capacity right now is 3%, and that he didn't think that the oil market was taking enough notice of this. 3%, you know, it really doesn't sound like a lot, and he seemed to be sort of putting a warning out there that, you know, any particular exogenous shock could actually make a big difference to this market. But again, there is spare capacity out there, and it is at 3%. The other thing that was interesting, particularly in the context of the Capital Markets Forum, is that Aramco is looking at likely issuing bonds this year, and that would be a boon to the Saudi economy and to the Saudi capital markets, which are trying to develop debt capital markets as well as equity capital markets, and that's one of the reasons this Capital Markets Forum is taking place.
OK, Bloomberg's Vonnie Quinn at the Saudi Capital Market Forum in Riyadh. Thank you very much indeed with the latest. Now let's get more from the Horn of Africa, where the feud between Ethiopia and Somalia is boiling over again. The two neighbours, already at odds over a controversial maritime pact, clashed at the African Union summit over the weekend. Bloomberg's Ondira Ogunga joins me with the details. Ondira, Somalia and Ethiopia's differences, they've been around for a while, coming to light again in quite stark fashion at this summit. Walk us through the latest.
Somalia's President Hassan Sheikh Mahmoud accused Ethiopian forces of trying to restrict their access to the summit premises, and this comes amid an ongoing row between the two countries after Ethiopia signed a memorandum of understanding with Somaliland to allow them sea access. The president of Ethiopia the president of Somalia went ahead to say that Ethiopia is misleading the whole world with this issue. The issue has never been sea access, but rather how Ethiopia wants to access the sea. He went ahead to also say that Ethiopia is preparing the ground for territorial annexation, something that if they try, Somalia will be ready in retaliation. But then again, Ethiopia has downplayed fear of potential conflict, and they said this was an isolated incident at the EU premises.
OK, Bloomberg's Ondira Ogunga with the latest on that African Union summit. Thank you. Coming up, we're going to take a look at what to expect from earnings this week, including European banks and, of course, when it comes to technology, Nvidia. That is next. This is Bloomberg. Welcome back. It is another busy week for earnings. Nvidia reports on Wednesday amid high expectations, with investors, of course, keeping an eye on how well it can continue to capture growth for artificial intelligence. Meanwhile, it's also a big week for European earnings, with UK banks firmly in focus. Bloomberg's Chloe Melly joins me with the preview. What are you looking for when it comes to Barclays then, Chloe?
So Barclays is really hoping to sort of boost and revive its lagging share price with a strategy update which will come alongside earnings tomorrow. And the focus will really be on cost-cutting measures because it's going through a restructuring. It's also making some targeted acquisitions. So costs will really be in focus. In terms of earnings themselves, we are looking for a drop in fixed income revenue. It's the same thing that happened with US peers, so that's kind of expected. And then also there's continued margin pressure. We've got the prospect of rate cuts fast approaching, so that will probably add to the squeeze. OK, and we're looking at Lloyds as well later in the week. Some similar themes there, or is this a very idiosyncratic story for Lloyds? No, it's quite a kind of similar theme. So we've still got margin, so margin outlook will be really important with the same context of rate cuts looming. Still also a focus on our costs because Lloyds announced recently a plan to cut about 1,600 jobs because revenue momentum is slowing. What's a little bit different here is that we'll look particularly at loan provisions. So Britain's financial regulator, the FCA, is looking into car finance loans, and that will impact Lloyds, and will probably look to increase provisions for that. OK, so from banks to technology, and of course the big one this week, Nvidia, given all the hype and expectations around artificial intelligence. Those earnings drop on Wednesday. Talk to us, though, about how the chip makers in Europe have fared. We don't have a European Nvidia. We do have a lot of chip makers, though. Yes, exactly. So Nvidia, I mean, the expectations are really, really high. In Europe, it's been a little bit more mixed in terms of chip makers. So chip making equipment maker ASML did really, really well. But when we look at actual chip makers like Infineon, like STMicro, it was more of a mixed bag, and they were dealing still with the slowdown in demand from industrial customers specifically. But the narrative here is kind of a transition year in 2024 and then going into really strong growth in 2025. And that's kind of across Europe and the US. OK, Chloe, thank you very much indeed. With a wrap of the earnings coming through on semiconductors out of Europe, and looking ahead, of course, to the banking picture out of the UK later this week. Barclays and Lloyds in focus for us. Now, AstraZeneca shares rose after trial data showed that Tagrisso slowed disease progression in patients with advanced lung cancer. It is another win for the pharmaceutical giant's blockbuster drug. The trial looked at Tagrisso as a maintenance therapy for patients with non-small cell lung cancer and a specific genetic mutation where there is no targeted treatment available. Very different story. Nintendo shares falling after Bloomberg reported that it is delaying the release of its next console to early 2025. The successor to the popular Switch was targeted for release this year. Nintendo now expects the device to come out in March 2025 at the earliest, missing the key holiday shopping period. Plenty more on these markets in the next couple of minutes. Stay with us. This is Bloomberg.